Okay, it's time for First Call, when the BNN Bloomberg viewer gets an opportunity to put a question directly to an investing professional. Today, that's Jeff Hull of Manulife Wealth. Here comes an email from our viewer, Mike in London, Ontario. Mike writes as follows: could I please get your guest's opinion of Netflix? Do you think it will split its stock?
Interesting one. Okay, Mike. Well, a couple different things, actually. Netflix, obviously a great company. They just reported Thursday before the holiday. Great numbers. It's a subscription economy company, so as a business, it's doing very well. Could it split? Absolutely. It's a choice for the company itself. Now, a lot of people get very excited about share splits because it makes it more affordable for more investors. Netflix is approaching $1,000 US per share. Does it make it more affordable? Yes. But in my opinion, it doesn't always necessarily make for a better opportunity sometimes that way. Nvidia went through this where they split 10 for 1, and all of a sudden, a share that was more expensive, around $1,200 at the time, now is $120, and a whole bunch of newbies and people piled in that maybe weren't sure why they were buying it. So sometimes when you get something that's cheaper, you start to have more masses, you start to broaden out your share owner base, which in some cases could be okay. But the challenge then is suddenly you've got a lot of investors that might just be short-term people that are entering it to kind of flip it around or whatnot. So that's where sometimes companies got to be a little bit careful. What's the purpose behind why they're splitting it? That's a real thing you got to look at. Is it a possibility for Netflix? Absolutely. Will they? We'll have to wait and see.
Important to remember that stock splits do not make a stock less expensive, do they? Because the relationships to earnings and revenue growth are all the same as they were before.
Exactly. I always say it's like a pizza, right? If you go 10 for 1, you have one big pizza, you cut it into 10 slices, it's still the same pizza, right? So sometimes investors forget that. Sometimes people think they're getting free stock. It's not. It's the same company, just reordered in a different way.
Okay. Thanks for that question, Mike. Let's go to another email. This one comes from Clara. Clara is in Ajax, Ontario. What's your long-term outlook on CP Rail, known, of course, now as Canadian Pacific Kansas City?
Yeah, Kansas City Southern was a very interesting acquisition for CP. It really gave them more than just a Canadian railway. They had Kansas City Southern was one of the smallest of the rails in the U.S. It has this very unique kind of service line that goes from the middle kind of the U.S. down into Mexico and back, which was good for cars and other products and services. So now that's all into one. It's an interesting company. Dividends about 0.71%. Its one-year return is down 11%. Obviously, there's going to be a reordering of what's happening with rail and transport, depending on what happens with Trump and his tariffs. Who the next prime minister is, if it's Carney or somebody else as an example. Can they negotiate with Trump, and how will that affect things? Will the provinces truly bring down those trade barriers so we can actually have free trade within our own country? So there'll be a lot more moving of goods west and east rather than just south of the border as an example. So there's opportunities there, but boy, oh boy, they got to be right on it, keep their hand on the pulse of it, because it's a tricky time for all companies involved with anything that's transporting across borders and tariffs. There's a whole layer of added complexity that they have to manage. We'll have to see how they do from there.
The acquisition of Kansas City Southern was obviously based on the NAFTA agreement, its replacement, what we call CUSMA in this country. In other words, trade between Canada, the U.S., and Mexico. In fact, the network, CP Kansas City's network, now runs all the way into Mexico. How much of a headwind are the tariffs?
It is for everything, because when a CP is trying to look forward to their business in the future, how do you project when all of your customers aren't sure what they're doing? They're all in almost this frozen state of sitting on their hands. Do those businesses pile in and order extra right now ahead of larger tariffs, or do they kind of sit on their hands, wait and see to see if tariffs actually come off? So it's very tough for businesses, therefore their entire customer base, to make real concrete decisions in a world in Trump's orbit where it's a world of fog and smoke and mirrors. It's hard for them to determine. So it's tough for CP to really get a full handle on their business. Things can pivot very quickly. The good thing is it's a good business in the sense that they have the ability to make changes quickly when needed. But you're right, that little section they have from Kansas City Southern is a real interesting asset for the company. It's a little bit unique to them, and I think that'll give them some abilities. But again, the challenge they have right now is what's Trump going to do next, because Trump and trains may or may not mix.
Okay, let's go to another email. Peter in Sault Ste. Marie, Ontario. Peter writes as follows: would you consider Enbridge and TC Energy a buy, and at what price?
I'll focus more on Enbridge here. So Enbridge is one that a lot of Canadians tend to own. Enbridge is an interesting business. They're a fairly well-run business. I do have some concerns, obviously, back to Trump as well and energy and everything else going on. One of the challenges that business has is CapEx spending. a business that at any time, from weather to trade deals, et cetera, can completely alter and reorder its entire business plan. So you don't really have a full handle on what's going to happen. You know, whether you look at electricity companies and others even, you get an ice storm and all of a sudden a whole bunch of spending that they weren't expecting goes out the door to upgrade lines and maintain things. And same for Enbridge here with pipelines and things even. There's always this kind of upgrading and maintaining and on and on and on it goes. So it's tough to manage that. So I'm a person that tends to gravitate generally away from a lot of business that have a lot of unknown CapEx spending that's a perpetual thing that never stops. But overall, the company pays a 6% dividend yield, which is pretty strong as an example. One-year return on Enbridge is about 36%. Decent business. I think it's a good business overall. I'm personally not buying it, but overall, I think it's a decent business. If that's the type of thing you and your advisor are looking at.
That's Jeff Hull on the two big pipeline stocks. I've got a question for you. Apple is a stock that we get a lot of calls here about, and there's among people like yourself, investing professionals, there's also a pretty vigorous debate on whether this company has seen better days, and the stock has seen better days, or if there's opportunity here in an Apple stock that is well off its peak.
Yeah, I always say never bet against Apple because there's so many things and levers it can pull. It was the biggest company in the world for the longest time. Now it's Apple, Microsoft, and Nvidia are the big kind of three largest entities in the world. But there is a lot of worry in the sense that Apple could be used as a piñata from China and tariffs as an example. They could start hitting Apple because it's an American company. It's an easy target. Kind of like Tesla, it's an American company. But then when you look at it, if you reverse it, Trump wants to see things made in America rather than overseas and shipped in. But then Apple's already assembling everything in China pretty much, and just like Tesla is as an example. So when you have these great businesses that are in every country and every currency in the world, they've got a lot of levers they can pull, but also have a massive installed base. I see your iPhone there. I got my iPhone here as an example. You know, whether Trump got in or someone else gets in or there's a trade war now, I don't think we're going to throw these in the garbage anytime soon. But there's areas where Apple could improve. I'll give you a good example. Netflix with 302 million plus subscribers. Amazon Prime has a lot of subscribers at 200 million. Apple's at 25 million. So you can either look at that as they've got a long way they can grow, or they can better utilize an enormous embedded client base of Apple product users worldwide. I would say once someone's in the cult of Apple, they rarely leave the cult of Apple. So overall, long-term, it's a good business, but they have to keep fine-tuning to keep that business fresh and refreshed for the consumer. Okay,
another stock, as you know, we get tons of calls on is Nvidia, and I know you've been an Nvidia bull for a long time.
Yeah, it's a great company out there. It's very rare you see a massive company with a complete total dominant market share. So in video gaming, they're well over 90% market share in video gaming chips. But most importantly, especially the last couple of years, especially since ChatGPT was more well known, the whole AI space and artificial intelligence, total dominating force in that area. Over 80% of global companies that are doing AI are running on Nvidia chips, especially the new Blackwell for those that have the privilege to get access to that. Even DeepSeek from China was running on Nvidia chips as an example. ChatGPT was started on Nvidia chips and still is as an example. So all these companies, Nvidia is kind of almost the backbone for the entire AI infrastructure and a lot of cloud storage and everything else that's out there as well. So it's an interesting business. I think they've got a great future overall. And again, anything that's a dominant business, it's a great business to be in.
Jeff, always a pleasure to have you here. Thank you so much.
My pleasure.
Jeff Hull was our featured guest. He's at Manulife Wealth. Here's a quick look at markets before we turn things over to the Open and Andrew Bell. U.S. futures have been down all morning long, and they remain in negative territory. There you see the big three in the U.S. futures market. Andrew Bell and the Open up next.